Welcome to Yield Nerd, an educational show about how you can acquire and manage yield. All right, Yield Nerds, I am going to take you on a very scary ride. I'm going to call this the Yield Grand Canyon, the nightmare scenario. Let's talk about it because this is absolutely a nightmare that may indeed happen in 6 months. So, what is it that we are talking about? And before I dive deeper, because there is a lot of background that I'm going to be discussing, I want to make sure you understand I am not offering you investment advice. This is purely education. I do not have merchandise to sell you. I am not pitching or espousing any political philosophy. So make sure you keep that in mind. And let's kind of first start looking at what kind of a low volume note is going on in the industry. What are we hearing? And then this is about the debt ceiling, obviously, that may come about in summer. And then what did history say about debt ceiling and where it could go? And then we're going to look at what happens to the yield market or what could happen to the yield market if there is no compromise. And therefore, what should you do as a yield nerd? That is the idea of this episode. For new visitors, if you're joining in and this is kind of a higher level or more complicated topic, please note that our show is organized as a playlist and it literally takes you from a middle schooler who has no idea about yield investing all the way until being able to understand episodes like this. We appreciate your support and feel free to join and listen in the order of the episodes. You're welcome to it. All right. A couple of quick things because we're going to be diving into some politically sensitive topics here. I am not espousing any political philosophy. We're going to talk about what happened when debt ceilings approached in the past, what happened when there was no compromise, what happened when there was 11th hour compromise, and what did it mean for yield. That is really what we're going to focus on. So with that said, let's look at what happened in history. There was kind of a low volume note saying, Janet Yellen, this was January 13th, a few days ago, saying, hey, by the way, we're going to hit the debt limit Thursday. And so in 72 hours, something like that, we'd hit the debt limit. Now, what does that mean? It means it's kind of like reaching your credit card limit. It doesn't mean that you cannot spend another dollar because maybe you pay the monthly minimum because you do have new money coming in. However, if you ask for a credit limit increase, the card company says, oh, whoa, you haven't kind of paid off your balance. I want you to pay off the balance before I increase your limit. So we're hitting that funny number. There is still money coming into the bank account. There is money being spent, but we can't ask for a higher credit limit is kind of what it's saying. So that puts the country on a course that will have implications on yield, and that is what we're going to discuss. So the message from Yellen is that in the past, even a threat that we may not be able to pay treasury bond interests or pay back par value, or the credit downgrade that happened in 2011, that could create great harm. So let's not let it get there. That is Yellen's message. And then you ask the question, really, was there a credit rating downgrade? Why did it happen? Now, why do credit ratings get downgraded for a corporation in the corporate bond? It's because the idea is that the company's earnings are what are used to pay off the debt payments, the obligations. And if the earnings are lower, or if the company has too much debt, that servicing the debt is going to make the company unable to invest in growth, then credit rating agencies may downgrade the debt. And the S&P, goes back to 2011. I would encourage you to read some research on what happened to S&P management when they did the downgrade. The CEO got fired. And so there's a lot of history that goes behind it. But this was the message from the S&P. We believe, this is 2011, we believe that there is a material risk that the policymakers may not reach an agreement, and that is going to create a problem. And 2011, they did reach an agreement. The S&P downgrades the country. Moody's waits a little bit, and they said, well, there is too much polarization. Remember, this is 2011. They're not talking about 2023. 2011, they said, oh, there is a lot of polarization. We're probably going to default. We're not going to wait until the default to decrease the credit rating. We're going to go ahead and decrease the credit rating. And I want you to kind of relate 2011 to 2023. Do you believe that there is a risk that policymakers will not reach an agreement now? How does that risk compare to 2011? Do you think there is a lower risk now or a higher risk? You do the math. Do you believe there is more polarization in 2023 or less compared to 2011? You do the math again. So the question, and this again is 2011, in the left, they said, oh, the credit rating wasn't our fault. It was the Tea Party downgrade. And the right said, well, this isn't our fault. The government couldn't control spending. So they started pointing fingers at each other. The credit rating goes down. It created a big uproar. And the credit rating was indeed fixed a few months after the country agreed on how they are going to structure debt. And this came down to the wire. In 2011, the credit rating downgrade happened one day before the debt ceiling hit. And S&P had management changes. Both parties criticized the downgrade. And a few months later, the credit rating was fixed again. In 2014, some of you may remember there was actually a partial government shutdown. National parks shut down. People were told you couldn't have salaries. We don't have the money to pay you. And literally 12 hours, the midnight before there was going to be a default, the debt ceiling was adjusted in 2014. So we've come really, really close in the past. And that was with polarization that existed before. What do you think will happen in 2023? Do you think the country has more people that will have a common goal and bail it out? You think through what that is. So let's look at what people are saying. There is an article, it's an extremely interesting article, which talks about the Biden administration is preparing for debt ceiling discussions as though there isn't going to be cooperation. However, in public, their message is you are not going to do some hostage taking. You are not going to drive us to compromises. So that's the public and the private message in 2023 from the left. From the right, the message is, hey, we are about to max out our credit card and we need to live within our means, which is proxy for spending cuts and steep spending cuts. Even the 2019 deal that averted any of the debt ceiling discussion, even the one that was successful between the left and the right, is now considered a bad deal. And so if the deal that was struck 3 years ago is a bad deal, one party says we need deep spending cuts, and the other party says, I'm not going to let you hold me hostage. What happens? I do not want to wish this for the country. This is an educational show. But what happens if there is no compromise and the country defaults? Think about it. We either will not be able to pay Medicare, Medicaid benefits. We will not be able to pay military salaries. We will not be able to pay treasury interest and return par value. By the way, this is in 6 months. If one or more of those happen, and nobody wants it to happen, the credit ratings will start getting affected a couple of months before that. The first shot across the bow, this is leading up to the 2011 credit rating downgrade. The first shot above, started happening as the country progressed towards the debt ceiling date. Some of the credit rating agencies, as you saw earlier, said, I don't think this is going to get fixed. I'm just going to downgrade right now. So the country started in a AAA at the beginning, and it was downgraded to AA plus, went to AA minus, and there was a wide panning of why would you do that, and it was fixed in 2013. And the credit rating wasn't much of a debate until 2019, when the debt deal was seen as a wonderful positive thing. And of course, COVID came and US became the default currency, the strongest of available options. And so we really haven't seen credit rating as a problem compared to or in conjunction with debt ceiling issues, because the last time we had this was 11, 12 years ago. So previous debt ceiling warnings did have a material effect on credit rating and a material effect on interest rates. But post 2020, as we all know, interest rates have been historically low, slowly creeping up. And so the question is, what would happen if there is no compromise? This is the day after default scenario, something that you and I do not want to see. The first possibility is if a corporation, ABC Corporation, goes from a AAA to a AA, and they have never ever had a credit rating downgrade, what do you think will happen? Their cost of borrowing is going to go up. If their cost of borrowing goes up and they have not made interest payments or par values, you may know that most of the treasury auctions have these large banks, and I don't want to mention bank names, but you can Google which banks mandatorily participate in treasury auctions, and it's all the big names. They all commit to buying X amount of debt at every treasury auction. That is why they become the broker dealers. And those banks have huge reserves of treasuries. Their balance sheets assume that they will get these interest payments and par value returns. If we cannot pay, those banks will have an upside down balance sheet. Well, if you don't have the money in the bank, you can't lend it. And they're float, meaning you have to have 7 cents to lend a dollar if you're a bank, and that number itself gets adjusted with some of the recent laws. But at the end of the day, if you don't have money in the bank or new money is not coming in, you cannot loan. So banks will start calling loans. If you're a business that is making profit and the bank suddenly says, I need you to return my loan, what are you going to do? You're going to say, ouch, I may have to sell the factory and you're going to default, or you are going to have a problem. This is going to cause a huge ripple effect if at all this happens. So the default will trigger interest rate increases, the financial system, getting absolutely shaken down, and businesses suffering from banks calling loans, and equities suffering from their valuation getting trashed. And because of the lower credit rating, yield will go up, not down. All of the pundits who are now predicting that at the end of the year, yields are going to start tapering down will actually see yields going up. That is a very strange scenario. Obviously, the pundits don't think there will be a default. That is why I'm saying if the default happens, here is what would happen. Crazy hypothetical world. What would a yield nerd do if you believe that there is going to be a default? First of all, you are sitting here believing that there is going to be volatility in treasury yield around June, July, August. I mean, there are extraordinary measures that can be done where you prolong that D-Day from June to maybe July, July to maybe August, but it will start manifesting itself, like the national park shutdowns, that sort of thing. So be careful if you're planning a summer vacation in a national park. Expect some surprises. Maybe it'll happen, maybe it won't. There may be an equity crash July or August. There may be a sudden yield increase somewhere around that time frame. And so what would you do if you're a yield nerd? In theory, again, you make your own decision. This is education. You wouldn't buy longer term treasuries because you don't want your treasuries to fall in value. You would keep a cash stockpile for June, July period. So when the yields spike up with an unfortunate scenario of a credit rating downgrade, you can go buy the higher yielding durations and also look at possibly longer durations later. Don't look at longer durations now. That is what a yield nerd would do if you believed in the D-Day scenario. And unfortunately, there may be an equity crash in June, July. And if you believed in this crazy scenario that we don't want to happen, you would just sit and wait to cherry pick equities in the middle of the year. What does that mean in terms of terminologies we have used? You should eat more ice cream. What do I mean by that? If this is duration, you would buy very short term duration, 1 month, 3 months, 6 months, just keep cash, 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 and just don't increase duration now at all. And remember that boring yield curve that we showed you where the yield curve is getting inverted, but the inversion point is shorter and shorter, and said, oh, big deal. And then we said, oh my God, look, long-term yields are decreasing. And that is because the market is expecting that the Fed will drop interest rates. And if the Fed drops interest rates or tapers, as they, in terms of the yield curve going up and up, it'll, a lot of discussion about it's going to reach a peak in the middle of the year and it's going to come down at the end of the year. That is why you see this happening. Instead of this, if D-Day arrives, and which is a terrible, terrible thing, if it arrives, get ready, you will have a yield Grand Canyon. What I mean by that is in the very short term, this is a possibility. You would have really high yields because the risk is very high. The government may not have the cash to pay. And then it kind of stabilizes. And if the country, you would expect that things would get resolved in a month, a couple of months, whatever it is. Hopefully, it doesn't even go that long. However, even the long term will go high, and that would be a point where you buy long-term treasuries that pay a huge yield. And when the country claws out of that yield crisis, you will now sit on long-term treasuries that pay a high amount. And if equities do crash, if the economy does crash, you have to imagine that interest rates will drop down. And so the country will have really low interest rates to re-stimulate the economy, and you will sit on high coupon long-term duration treasuries. That is the crazy scenario if you believe there was a D-Day. The realistic scenario, cooler heads will prevail yet again. There will be a debt ceiling deal. The country will dig out of short-term trauma. However, I would suggest be smart. Think about how you want to position your yield purchases, your duration, when you want to enter the equity market. All those are personal decisions. And last but not the least, every one of these spreadsheets I use, they are available for you. Email me, and I'm happy to share it. Thank you for watching Yield Nerd.